Coming up on Market to Market, the backlash over tariffs drives farmers and ranchers to the halls of Congress. One county's effort to cut commuting time and reinforce the local economy, and market analysis with Sue Martin next.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at AccuSteel.com.
This is the Friday, July 20 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Delaney Howell. The back and forth over trade has cut agricultural revenues and put more than one project in rural America on hold. The ripple effect has increased costs on Main Street, but consumers have looked past the higher prices. Retail sales rose 0.5% in June as consumers paid a little more for gasoline and new cars. When those factors are taken out of the equation, retail sales rose 0.3%. The construction of new homes plunged 12.3%. Home builders remain confident the market will expand as the number of properties available declines. Rising costs and falling incomes brought on by the blow-for-blow trade battle have put rural Americans in a corner. With agriculture square in the crosshairs of nearly every retaliatory move, farmers and ranchers brought their case to Washington. David Miller has the story.
Envoys from several sectors of U.S. agriculture testified before the U.S. House Ways and Means Subcommittee on Trade this week. The committee's consensus was that agriculture is caught in the middle of a tariff battle.
Now, I know that the administration didn't intend for the U.S. agriculture to be hurt or harmed, but the damage is entirely predictable. U.S. agriculture just isn't in a healthy place, and that's putting it mildly.
We are in a slippery slope. We don't know where it's going to end, and we don't really know all the consequences.
In light of pulling out of TPP,
the select panel of witnesses was direct, making the committee aware how each new tariff was putting the squeeze on agriculture.
Margins are razor thin to negative currently. So where do we absorb these extra costs? It's really tough to swallow right now.
According to USDA, last year, 43% of the nation's agricultural output was exported to the country's top 3 trading partners, China, Mexico, and Canada. The panel made it clear that with each new tariff, a portion of U.S. market share evaporates.
If our president is successful, and we desperately want and need him to be sooner rather than later, this could be a tremendous opportunity for agricultural trade. But absent a successful outcome, farm and ranch families like ours will suffer.
Those testifying were asked what they thought would be the outcome of a long, drawn-out trade battle.
It also takes out the people that supply those farmers and ranchers, the feed store, the fertilizer dealer, all the people that supply the things that we need to raise the products that we do. So yes, it has a tremendously long tail.
Committee members expressed empathy for the panel, but were divided on who should shoulder the load.
So no, the end result here is to try to get a better playing field for you guys. And I feel your pain, and I want to do anything I can to make it speedy and ameliorate it.
It's going to be a roller coaster, and it has been a roller coaster. And as a rancher myself, who just sold 31 steers today, I understand how the market changes very quickly. And I'm telling you, I am very glad that I have someone in the White House that I trust that's willing to stand up for our farmers.
What Congress is telling you is, despite the fact that it has the constitutional authority to help you, they're not going to help you.
Unfortunately, from my perspective, I don't see it ending very well soon or very safely.
For Market to Market, I'm David Miller.
As rural populations continue to shrink, rural businesses are looking for new ways to restore the dwindling pool of employees. A variety of plans by community leaders and entrepreneurs to attract and keep a workforce have focused on the benefits of small town living, proximity to work, and steady income. For one rural Midwestern county, it's all about location, location, location. Peter Tubbs has more in our cover story.
I love the house. There's tons of room. I'm really close to the Y. I'm really close to work. I'm really close to 80 if I want to go anywhere in Nebraska.
When Ashley Reeves and her husband were shopping for homes in Holdrege, Nebraska, the supply of homes that met their needs was smaller than they expected. But they were willing to take the plunge because their alternative was to live in Kearney, Nebraska, a 45-minute drive away. Phelps County, Nebraska has a housing problem. Despite a stable population, homes close to job opportunities are few and far between. The result is hundreds of commuters living in adjacent counties or commuting from cities like Kearney. To increase the construction of new homes, the Phelps County Development Corporation created the Go Home program in 2017, which provides funds for lot preparation for new home sites and rebates the sales taxes paid on purchases of building materials within Phelps County. Funds from the PCDC program were used to build 3 new homes in Loomis, a town of 380. They are the first new homes built in the village since 2014. Rehabbing an older home is also a hurdle for many buyers. Few want the headaches of doing the work themselves, but much of the housing stock in rural towns requires modernizing. PCDC provides forgivable loans for exterior improvements or the purchase of an empty lot. The organization also rebates sales taxes to contractors building or renovating a home priced as workforce housing.
There's a shortage of homes between $150 and $225, which is affordable housing, primarily for younger couples.
That range is targeted at those working full-time in southern Nebraska and is a price that 1 or 2 incomes can support and often includes the space for growing families. The shortage of worker housing in Phelps County exacerbates another local problem, a lack of workers in general. The unemployment rate in the county hovers around 2%, which makes filling vacancies, especially jobs requiring specialized or technical skills, difficult to fill. The Phelps Memorial Health Center has filled openings for management and high-skill positions using down payment assistance as an incentive.
So we were able to basically say, we'll give you $5,000 as a down payment assistance on the house. And so being able to offer that was really an advantage for us to be able to utilize that as a recruiting tool.
But the financial details of a home purchase can still be a challenge for workers weighing the merits of housing options. To encourage the move into Phelps County, the Development Corporation combines forces with local employers and matches down payments with up to $5,000 to help close a sale. The Becton Dickinson plant on the west side of Holdrege is the county's largest employer and runs 3 shifts per day making medical devices. Many of the 660 workers at the plant drive 30 to 60 minutes to work, often in challenging winter weather. Converting workers from commuters to residents can reduce absenteeism and improve the employees' quality of life. Lacey Wright is slowly unpacking during her first week in a house in Holdrege. For the past 15 years, her husband drove 30 minutes one way to work in Holdrege at BD. The move cut his commute down to 5 minutes.
The program, the grant that we got was my husband's company matched what Phelps County was going to put down to help towards closing costs. And it ended up being so we had to put nothing down for closing costs. That kind of helped sway us more here.
In less than a year, Becton Dickinson assisted 8 employees in purchasing homes in Phelps County with down payment assistance.
I know there's an interest out there. This has been a popular program, and there's been a great deal of interest about it. In fact, we'll probably award all the targeted funds on this a lot quicker than the calendar year will be done to do it because it's been that popular.
Some of the technical jobs in the plant need short response times if there are problems, which are easier to solve when the employee lives close to the factory.
We don't have many people who need to be on call, but some of our technicians and folks like that, we like to have them be able to get in here within 15 minutes to a half hour if we have an issue that they need to support.
The dollars for these projects come from a portfolio of 24 local, state, and federal programs that focus on housing needs in rural America. Projects range from buying and destroying housing that has exceeded its useful life, to increasing housing for elderly and senior populations, and expanding the general supply of rental properties. The major goal is encouraging the construction of single-family housing in the county to serve the working population. The county needs 170 owner-occupied and 100 rental properties to be constructed by 2022 to meet worker demand. The fully furnished Washington Square apartments were built on the site of a former elementary school in Holdridge. Local companies committed to long-term rentals for their transitional staff to help solidify the finances of the project, moving the apartments from drawing board to reality. Bringing new residents to the town of Holdridge and Phelps County at large keeps the economic momentum moving forward, tacking against the winds battering much of rural America.
It's a great place to raise a family. You don't have a lot of the challenges that you would have in a larger community.
For Market to Market, I'm Peter Tubbs.
Next, the Market to Market report.
The commodity market clawed its way back from last week's losses as weather and South American shortages competed against tariff news. For the week, September wheat rose 19 cents, while the nearby corn contract rocketed 14 cents higher. Word of a soy meal shortage in Argentina, meshed with declining crop conditions and improving weather in the U.S., helped the soy complex to put back 2/3 of last week's losses. At the close, the August soybean contract gained 31 cents. August meal gained a scant 90 cents. December cotton shrank 76 cents per hundredweight. Over in the dairy parlor, August Class 3 milk futures fell 14 cents. The livestock sector finished mixed as the August cattle contract put on 438, August feeders bumped up 295, and the August lean hog contract shed 370. In the currency markets, the U.S. dollar index dropped 27 ticks. Crude oil continued its slide, falling $1.69 per barrel. COMEX gold shrank 10.10 per ounce, and the Goldman Sachs Commodity Index faded more than 5 points to settle at 457 even. Joining us now to offer insight on these and other trends is one of our regular market analysts, Sue Martin. Sue, welcome back.
Thank you, Delaney.
Sue, we certainly had a busy week this week. Let's start off here talking about the wheat markets. We've got quite a bit of weather going on both domestically and internationally. What do you think production numbers are going to be this year, and how will those affect the wheat markets?
Well, I think that first off, global production is going down. You've got Black Sea wheat that's been in decline, and we know that Russia had excellent crops a year ago, and they're in a pretty good decline. Ukraine is having some share of issues. You've got France with too much rain. And so we're just looking straight across. Germany as well is having their share of issues also. So it's like we're picking away at the global crop, and it's not just the wheat, it's coarse grains as well. But globally and domestically, we're seeing reductions. And so I think the one thing we do see with Europe and having France in so much trouble right now with just way too much rain, I think between the good quality that we have in our protein in our wheat will be a good thing to help us become more competitive in exports because of the quality. I think that also the other thing we're going to see is that Germany won't be much help. And, you know, we're even hearing Poland may be starting to show signs of issues. So it's the durum wheat that also could be of good, you know, in demand. And that's one area that we do have in this country. That, along with the hard red spring, looks in very good shape.
All these factors I'm hearing, Sue, hopefully going to pull back ending stocks this year with all those weather issues?
Oh, I think we will. I think we will. Globally, we've already
Enough
started
to make any significance, I guess, is the big question.
I think so. I really do. I think we are into demand markets for both wheat and corn. And this year, it looks like we're going to have a better chance of competitiveness being able, because of lack of production elsewhere, and the good quality, the protein, the higher protein. I think we're at around 12.8% in protein, and a year ago we were around 11-something%. So I think that that's a good coup for us. Canada's crop's probably going to be okay too. But I think we're going to certainly, and Australia, they're having their share of issues as well. So it's kind of like all these dominoes that have kept falling because of poor weather. China, they're having a lot of weather issues also. Their typhoon season looks to be the worst, probably even worse than 2010-11. And that was the year they turned a huge importer of corn.
Okay, I want to talk about weather a little bit more in the corn and soybean markets, but let's move on to corn, because we've had 5 consecutive days trading or closing higher in the corn markets. Have we put the bottom in?
I hope so, but I don't think so.
Okay.
I think that what we'll see, I went back and I looked at some data since 1970, where in years when you put new contract lows in on December corn in the month of July, it tends to, in fact, I don't think one year where you did rally out of that and hold that low. Bear markets do have rallies, and I do think regardless of tariff or not, we'd have been in a correction anyway. And if we look at 2016, the market that year peaked in June, broke 19 consecutive trading sessions, $1.06.50 straightforward, bounced, and then dropped down to late August for a total of $1.33.50. This year we're, I think 79 cents. And I think that speaks to the demand base that's under this market in the corn. But because it's very rare for July lows to hold. I'm thinking more what I'd like to see is the markets try to get some lift here, turn around, come back down, take a look at these lows, maybe you tag them for just a little bit, and we run out of sellers. That would be awesome, because then I think we would have our bottom in and be rallying into 2019.
Do you expect us to go back down to that 335, 336 level?
Basis, that was off of the July, and the September could go back and look at 338, 340. December could come down and try to take these lows out and push for 340 or something in that area. December corn has to get through 374 before, and that's not far away.
That's the next level of resistance you're looking for in the December contract. Okay,
exactly. And then we can start to push forward and maybe say, okay, now maybe we do have this, and then we know where our line in the sand is underneath. I think just because of past behavior, normally if a July low is going to hold, it's a year where you've been negative most of the first half of the year, and we just didn't have that. So I think our demand base is excellent. But I think right now we could still see a push and then another comeback and take a look at these lows one more time.
Okay. I want to talk a little bit about crop conditions here. What have you been hearing from producers? And we're pretty well ahead of pace for this time production-wise. Do you expect us to continue to hold?
I think that the crop conditions this next week will deteriorate maybe 1 to 2%. They deteriorated worse this past week, but we had the heat. This week we're a little bit on the drier side, cool, well not, maybe we are drier, and cooler. But I think what it is the crop's ahead maybe as much as 2 weeks. And so by being that far ahead, it's not getting quite the benefit it would have. I think that the good thing is the nighttime temperatures have cooled. That'll help with fill. But I think that when I look at the crop, this is the one thing I've noticed is that as fast as the crop has been coming, and if we remain dry and where the ridge seems to be setting, I would say that it's going to not allow much moisture out of the Gulf up. So we're going to see what rain that does come maybe be very light. I think the traders on Monday will have looked back at the weekend and said, okay, maybe we didn't get too much rain, and that might propel us a little bit. But I think in another week out, we might see us stabilize, and then we'll go from there.
Okay, Sue, let's move on to the bean markets, because we certainly had some big news this week with President Trump announcing he would consider putting on $500 billion worth of tariffs on China, and that's our #1 exporter for soybeans. We have a good social media question I think kind of ties this all in this week together. Joseph from Wisconsin said, with the decline in the price of U.S. soybeans over the threat of tariffs, Why did the rest of the world put soybeans on sale? Or is it the U.S. market is the only one taking a big hit?
I think that, you know, beans around the world are priced in many places off of the U.S. dollar. But what happened is that, like, for example, in Brazil, farmers weren't pushing beans as fast to the port. I mean, they're getting beans because obviously their exports are way up from normal, but the farmers aren't as aggressive pushing because of the freight costs.
Exactly, and they
after
had the trucker strike.
Yes, and so that's been kind of slowing things up, but also then causing the basis to really, on anticipation of Chinese demand, and knowing they're going to be the first game in town now. So that's helped the basis push. And then on top of it, the trucker strike causing farmers to hold back, trying to entice them to come. So consequently, they're running around 22, 23% of our 25% tariff.
Which is almost equivalent then. I mean, it makes the tariff almost a wash.
Exactly. And what I find is that when I look at the U.S. dollar and I look at charts on the dollar, it looks to me like we could be hitting some resistance levels here. And if that's the case, we could see a little bit of a correction in the dollar. That could make us look even more attractive, or at least even Steven, you know, and maybe they'll come to us and buy. The good news has been that through this, we have had other buyers coming to us, like Colombia, Spain, Vietnam.
Pakistan, I think, had good sales this week.
Yeah, Pakistan, they're our 10th largest buyer. They've been in the market, not to mention our normal everyday ones. So I think that we're seeing demand being good. You know, the question and the concern is, does that last for a long time? You know, is that the status quo we start seeing?
Right. Really quick, just your 10 or 15-second thoughts here. When we look big picture, if and when a trade deal does get put in place with China, what will the soybean markets do, and what should producers be watching for as that happens?
Well, I think it'll rally. I think first off, it was the psychological expectation of it. Remember, beans had a negative underpinning under them anyway. And so I think that the market really fed horribly on itself, huge outside range year. I think we'll rally. We'll get a nice sharp rally. The thought is that you'll see less bean acres in 2019. That might help start stabilizing us. One thing we may see is that maybe we don't send as much beans out the door to China. Maybe we send soy meal. I think demand for meal is going to be very good. And of course, Argentina, #1 exporters,
absolutely
having an issue. And we also seen them in our export sales mix this week, where they bought corn, wheat, and beans.
All right, Sue, let's jump over here into the livestock markets. We had the cattle on feed report come out today, or on Friday. Nothing too exciting, but one question I did have coming out of the report is we had on feed numbers 3.4% higher than marketings, and I just wanted to know why that was.
Well, I think that we've been seeing cattle coming out of the pastures because of the heat in the south. I've had people telling me that ponds are drying up, ponds that maybe in 30 years have not dried up. And so we're seeing a movement of cattle. Another thing I will say is that I think our slaughter has been really largely beef cow, slaughter. And if you took those out, we wouldn't maybe even have a wall of cattle. Slaughter for steers is down this year since January 1st, and heifers higher.
Okay, really quick here, I want to ask, why have we been seeing the cash trade and live cattle markets hold up as well as it has?
Demand. Very bold demand. I think what we've missed is, I don't think there's been enough attention paid to immigration and the migration of people. And when they migrate for two reasons, either persecution politically or the lack of food. And when they migrate, they go to countries that have food programs, and they know they're going to get their full meals, eat protein, what have you. A lot of these people migrating are protein eaters. And if they're Muslim, they won't eat pork, but they'll eat beef and lamb and other things like that. So I think that when we look at the migration, there's all these people eating so much more. They eat cuts we don't. They're also huge hamburger eaters too.
Yes.
And you know, the hamburger market's been very stellar, continues to hold. I think our cutout is bottoming, and I think, you know, it'll probably be pulled higher. Maybe we push up towards 210 on the cutout for choice. That might come off of ribeyes, rounds, and chucks, and hamburger. But I also think the cattle market's going to surprise us in August, and I think we could see a cattle market that pushes towards 115 in the cash market.
All right, Sue, we're going to save your thoughts on the hog market for Market Plus. Thank you again for joining me.
Thank you.
That wraps up the broadcast portion of Market to Market, but we will keep the conversation going on Market Plus, where we'll answer more of your questions. You can find it on our website at iptv.org/MTOM. When our producers travel, we take you along for the trip. This week on our Instagram feed, we published images of wind turbines being refurbished. Give us a follow at IPTV Market. Join us again next week when we look at new uses for the next generation of cover crops. So until then, thanks for watching. I'm Delaney Howell. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content.
Wherever your operation takes you, or who you share it with, we'll be where we've been all along. With you from the word go. Proud sponsor of Market to Market.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
AccuSteel, offering fabric-covered buildings specifically designed for the cattle industry since 2001. The next generation of cattle buildings. Information at accusteel.com.